Hi guys, thank you very much for joining us. My name is Mahar Afzal and we are discussing today decoding impacts of VAT on businesses in Oman. First of all, I would like to introduce myself. My name is Mahar Afzal. I'm a member of Institute of Chartered Accountants of Pakistan as well as member of Institute of Chartered Accountants of England and Wales. I'm UK and UE VAT certified professional. Along with this, I am transfer pricing specialist as well. So far as my professional experience is concerned, currently I'm working as a managing partner of Crest Cooper Chartered Accountants and Management Consultants. I started my career with PwC in 2004 and I have in total 15 years of experience. I was working with Galadari Brothers, which is one of the leading group of UAE, and the group deals in Mazda, Khalij Times, Komatsu, JCB, Baskin Robbins, and I was taking care of the VAT matters in the all GCC countries of the group. I was working with Baker Tilly as an associate director of VAT, and we had implemented VAT on many multinationals and local groups when the VAT was being implemented in UAE in the beginning of 2018. For the third consecutive years, I was a main speaker on the accounting and finance show of Middle East, and I was teaching strategic financial management to CAs and ACCAs for almost 6 years in Dubai. The contents of the presentation, these are the major contents of the presentation. We will be discussing what is VAT and how VAT works, VAT in GCC, VAT in Oman and its impact on the businesses, on the economy, on the government as well as on the individuals. We'll assess the taxability. We will see various key concepts of VAT and its transitional rules as well. We'll focus on various industries. We'll see the compliance requirements, impacts of non-compliance, what is the way forward for the businesses, and definitely will be there to help. So we'll look into this, how can Crest Cooper help you in the implementation, impact assessment and registration of VAT. So let's start our discussion. The first is what is VAT and how VAT works. VAT is basically, this is the consumer spending tax and its burden will be borne by the end user. The second thing is every registered business in the supply chain is a presumed collector of the government. VAT will be collected by the registered business, and after collection they will pay it to the government. So two things are very important in the definition. First of all, the burden will be borne by the end user. So whatever the burden of VAT, it will be borne by the end user. Second thing, every registered business in the whole supply chain is a presumed collector of the government. The registered businesses, they will collect the government and they will pay this VAT to the government. We'll look into this. So far as background of VAT is concerned, the concept of VAT was first proposed in 1918 by one German industrialist. The first version of VAT was introduced in France in 1954 and UK had introduced VAT in 1973. Currently in the world, in more than 160 countries, including 4 GCC countries, VAT has been implemented. VAT standard rate in almost in all European countries, this is more than 20%, but in the GCC countries, some countries have introduced VAT at 5%. Only in KSA, the VAT rate is 15%. There are two major strings of VAT. One is input tax, one is output tax. Whenever any business is buying anything like on the purchases or expenses, business are paying tax. This is called input tax. This input tax is the assets of the businesses. So in the same way, whenever the business is selling anything, business is collecting the VAT on behalf of the government from the customer. This will be collected on the sales, payable to the OTA, payable to the tax authority. This is a liability. So there are two legs, two strings of VAT. One is output tax, one is input tax. Output tax is the liability, input tax is the assets of the businesses. Ultimately, at the time of submission of return, these assets and liabilities will be netted out. In case assets are higher than the liability, then business will apply for refund. In case liability is higher than the asset, then the business will be liable to pay output tax to the respective tax authority. This very comprehensive slide, it will tell us how VAT works. In this supply chain, I have considered 5 players are there: the suppliers, manufacturer, wholesaler or distributor, retailer, at the end user. We have already decided that all registered businesses are the presumed collector of the government. We will look into this, how they are the presumed collector of the government. Then we have discussed end user VAT. A burden of the VAT will be borne by the end user. We will look into this, we will prove this as well. So we started this from the supplier, assuming supplier is making a sales of 100. This is the sales of the supplier. We have already agreed 5% will be applicable. Our respective VAT rate will be applicable on the supplies to the customer whenever the supplier is supplying anything. So 5% of 100 is 5. This 5 will be collected by the supplier. When this 5 will be collected by the supplier on the sales to the customer, so 5 will become output tax. This 5 is the output tax and this 5 is the liability which will be paid by the supplier to the government. So here supplier has acted as a presumed collector of the government. No manufacturer has purchases. After the purchasing, manufacturer is manufacturing. After manufacturing, selling into the market. Assuming manufacturer purchases are 100, manufacturer sales is 150. So 150 is sales. On the 150, output tax will be applicable, which is a liability. On the 100, 5 is the asset. So 7.5 is the liability, 5 is the assets, net amount is 2.5. This 2.5 will be paid to the government. Here, while collecting 7.5, businesses, manufacturer has acted as a presumed collector, and this 5, whatever the business has already paid to the supplier, this 5 will be claimed back. Net amount of 2.5 will be paid to the government. In the same way, wholesaler and distributor acted as well, retailer acted as well. Here the retailer sales is 250, and the 250 they will collect. This is output tax. On 200 they will take it back, input tax. So net amount of 2.5 will be paid by the retailer to the government. So 2 things we have discussed. Now the total value or end value of the sales by the retailer is 250 into 5%, 12.5. This 12.5 burden will be borne by the end user. We have already discussed in the definition. So how this 12.5 has been collected? 12.5 has been collected by the government, by the different players. They have collected 5 from the supplier, 2.5 from the manufacturer, 2.5 from the wholesaler and distributor, and 2.5 from the retailer. Total is 12.5. In this whole supply chain, all the players like suppliers, manufacturers, wholesalers and retailers, they have acted as a presumed collector of the government. They have collected, they have netted, and they have paid net amount to the government, which is 12.5. The burden on this total sales, which is 250 at the end, has been borne by the end user. We have proved this as well. This supply chain will continue like this. And OTA receivable, if I'm asking what is Oman Tax Authority receivable, this is total receivable is 35. Businesses have a right to claim input tax 22.5, net amount is 12.5. This supply chain will continue, is based upon the assumption that all the players in the supply chains are VAT registered person, because in case the supplier is a VAT unregistered person, supplier will not be able to charge output tax to the customer. Supplier will not be able to act as a presumed collector of the government. This chain will be stopped. Second thing, in case the supplier is dealing with the exempt supplies, then still supplier will not be able to charge output tax because exempt supplies are not subject to VAT. In case any of these conditions are not being met, like supplier is not a VAT registered party or supplier is dealing with the exempt supply, then this chain will be blocked, because the respective input tax will be blocked. Input tax will become cost of the businesses and the registered, and the businesses will not be able to act as a presumed collector of the government. So what is the accounting treatment? We have already discussed. Supplier has collected 5% on sales. This they will book an output tax as a liability in the balance sheet. In the same way, manufacturer, this is manufacturer, supplier's output tax, it has become manufacturer input tax. Then manufacturer sales is 150, and the 150 they have paid 7.5 output tax. 2.5 input tax, net amount 2.5. It will be reflecting net output tax 2.5 whenever the entry will be posted. Whenever this amount will be paid, output tax will be debited and cash will be credited. So ultimately these ledgers will become zero. In the same way, manufacturer output tax 7.5 has become wholesalers input tax. Wholesalers output tax of 10 has become retailer input tax. In the same way, retailer output tax at 12.5 has become the cost of the end user, because end user cost will be 250 plus 12.5. Total cost which will be paid by the end user is 262.5, and this end user will not be able to claim any 12.5 because the end user is not a VAT registered party. VAT in GCC. We all know this, there are 6 GCC countries. One is VAT, and in UAE VAT was implemented on 1st of Jan 2018 in one phase. At the same time, KSA had implemented VAT on 1st of Jan 2018 in 2 phases. Bahrain had implemented Bahrain had implemented VAT on 1st of Jan 2019 in 3 phases. Now Oman is in the process of implementing VAT on all businesses in the 4 phases. First phase, businesses having a turnover of more than 1 million Omani Riyal, they have already got themselves registered, and effective date was 16th of April 2021. So they have already gone for implementation of VAT on the businesses in the 4 phases, 4 categories. We are waiting for any announcement from Qatar and Kuwait, and I believe Kuwait will be implementing VAT in 2023. We are waiting for the Qatar, and hopefully they will implement the VAT very soon as well, because all GCC countries have signed the GCC framework, and as per the framework every country is liable to implement VAT. Definitely they will go for it as well. What is the reason of introduction of VAT? The major reasons of introduction of VAT in the GCC country was the diversification of economy, because everybody was assuming this is oil-based economy, so they were looking for, countries were looking for multiple sources of income, so they have gone for the diversification of economy. In the GCC countries, excise duty has been implemented in a lot of countries as well. The reason of implementing of excise duty is basically government wanted to stop the usage of some certain product which are detrimental to the health of the public, health of the society. So this was the reason that they have introduced excise duty as well. Moreover, government is providing in all GCC countries exceptional public services like healthcare services, excellent roads, excellent educational services, parks and social services, waste management services. So this was another factor that government was thinking to collect the money and to again spend upon the public, ultimately for the welfare of the public. So this was the reason that VAT was introduced in the all GCC countries. Impacts of VAT on businesses. This is very key slide. We will understand what will be the impact of VAT on the businesses. Then we'll see what will be the impact on the VAT on the individual. We'll look into the impact of VAT on the economy as well as on the government as well. So first of all, what will be the impact of VAT in businesses? Impact of VAT on businesses, it depends the businesses are registered businesses or unregistered businesses. If the businesses are registered businesses, we have already discussed that registered businesses will be presumed collector of the government. They will charge output tax on the sale. They will claim input tax on the purchases. Exceptions are there as well. We'll look into this. So net amount will be paid to the government. So for the registered businesses, there will be initial setup cost. There will be working capital impact as well, because there will be a timing difference in the collection as well as the payment of VAT. It all depends upon the payment terms. If they are debtors payment terms are higher then the creditor payment term, then that they will be required to inject the more working capital with the net impact almost of VAT. In case the payment term with the customers are lower than the payment term with the supplier, the businesses will be collecting quickly from the customer and paying late to the supplier. It will have a favorable impact on the cash flow of the businesses. So it all depends. They will be required to inject. In most of the cases, payment term with the suppliers are higher than the higher than the, sorry, in most of the cases payment term with the customers are higher than the payment term with the suppliers. So it will have adverse impact on the working capital. So business will be required to inject the working capital. Net amount they will pay output tax and input tax, it will be netted out, and net amount will be paid to the government, paid to the Oman tax authority. What will be the impact of unregistered businesses? We have already discussed. Unregistered businesses, they will not be presumed collector of the government, they will not be charging any output tax to the businesses, and they will not be able to claim input tax as well. Once they will not be able to claim input tax, so input tax will become their cost, and the operating cost will go up. Once the operating cost will go up, then we have the two possibilities. Might be they are shifting this cost burden to the end user, might be they are not shifting. In most of the cases, definitely they will shift this burden to the end user. Once they will shift the burden to the end user, the prices will go up. Once these prices will go up, ultimately things will become expensive for the end user. So it will be the treatment for the unregistered businesses. They will not keep the burden of VAT as well. So what will be the impact on the individuals? So far as impact on the individual is concerned, it depends what type of supply they are buying from the market. In case they are, so there are 4 types of supplies we'll discuss down the line with the different slides. In case they are buying any zero rated supplies or out of scope supplies, VAT will not be applicable on these supplies. These supplies will not have any impact on the individual. In case they are buying any exempt supply from the market, it will be indirect 5% increase in the businesses, because we have already discussed in case they are buying anything from the exempt supplies or unregistered businesses, things will go 5% up due to this, because businesses will not be able to claim input tax, they will not be able to charge output tax, but they will increase their cost. Once their cost will increase, they will increase the price, and they will shift this burden to the end user. So in indirect way, their 5% cost will go up of the ports. So far as standard rated supplies are, it will have a direct effect on the individual. They will be liable to pay 5% extra. So it will be the impact on the individual. What will be the impact on the government? Government definitely will be collecting. Government is in need of money, as we discussed. What was the reason of this? Because government is working on the public welfare, as well as they are looking for diversification of the economy. So government will be collecting money. So what will be the impact on the economy? Zero rated and out of scope supplies, they will not have an impact on the economy. Exempt and standard rated supplies, due to this, product will become expensive in the market, purchasing power of the people will come down, and it will lead to inflation. It all depends how much is the volume of exempt and standard rated supplies into the market. Based upon this inflation, I believe the inflation impact will be, because a lot of items are zero rated in Oman, around 100 items are zero rated in Oman. So I believe the inflation impact will be in between 1.5% to 2% impact, inflation impact on the economy. VAT development in the GCC, the process is basically all GCC countries, they have signed one framework, and after the framework, every country is introducing its own law, and after the introduction of the law, they are introducing the regulation. These are the procedural things, how the VAT law will be implemented, then the businesses are going live. These are the 4-stage process. In this 4-stage process, they first of all, they have signed common GCC framework on 11th of November 2016. UAE, KSA and Oman have already implemented VAT. They have already introduced their law. VAT regulation has been introduced by these 4 countries as well. And for the rest of the 2 countries, as I mentioned earlier as well, Qatar and Kuwait, we are awaiting for the announcement. They have still not introduced their law, and they have not till now introduced their regulations as well. So till now, you will be in a position to know what is VAT, how VAT works, what will be the impact on the businesses, what will be the impact on the economy, on the government, on the individuals, and what is the status of VAT in the all GCC countries. Now we are discussing VAT in Oman. Oman, as I mentioned earlier, VAT is being implemented in Oman in 4 phases. So first phase is the business is having a taxable supplies, annual supplies of more than 1 million Omani Riyal. They were supposed to apply for registration in between 1st of Feb 2021 till 15th of March 2021. The effective date was 16th of April 2021, which has already gone and businesses have already implemented VAT as well. This is the second tier, that business having taxable supply in between 500,000 in between 0.9 million. The effective will be on 1st of July 2021. These businesses, this category, third category, the effective date will be 1st of October 2021, and this category business having taxable supply in between 38500 and 249999, the VAT will be effective from 1st of April 2021. VAT registration, there are two types: VAT mandatory registration, voluntary registration. Mandatory registration threshold is 38500. We have seen in the previous slide as well. The businesses having a minimum taxable supplies of 38500, this is compulsory for them to get themselves registered, and 38500 limit will be applicable based upon the historic test and future test. Whenever they will apply the historic test, they will consider current month plus previous 11 months. Whenever they will apply future test, they will consider current month plus next 11 months. So if the taxable supply of the businesses in the current month and the previous 12 months, or in the current month and the next 12 months, is more than 38500, this is compulsory for the businesses. They need to apply for VAT registration. Businesses can go for voluntary registration as well in case their taxable supplies is more than 192500, and the same criteria would be applicable for the historic test and future test to assess the value of taxable supply, and they can go for voluntary registration. If the businesses have taxable supplies or expenses below 19250, then businesses cannot apply for VAT registration. So we can say if the taxable supply of the business is 0192500 or 38500 or greater than this. So if the taxable supplies or expenses are less than 19250, here the businesses cannot apply for VAT registration. If the taxable supplies are in between 19250 and 38500, taxable supplies or expenses are in between these two categories, then business can go for voluntary registration. And what will be the benefits of voluntary registration? Businesses will be able to claim input tax, and the businesses having a taxable supply less than 19250, they will not be able to register, they will not be able to claim input tax. And if the taxable supply is more than 38500, this is compulsory for them to get themselves registered. So what is the scope of VAT in Oman? So basically VAT will be applicable on every taxable person who is supplying goods and services. Supply of goods and services by a taxable person, it will be subject to VAT. And if the businesses based in Oman, the business is buying goods or services out of Oman, and where the reverse charge mechanism is applicable, where the reverse charge means the person, a business, will be liable to pay tax on behalf of non-resident supplier, then this person VAT will be applicable here as well. And third thing, import of goods and services. If someone is importing any goods, at the time of import of goods, they will be liable to pay tax at the time of import. These are the three main legs of the scope of VAT in Oman. Tax point. Tax point is at what stage tax would be applicable. We have classified this section into four categories: one-time supply, continuous supply, vouchers, and imports. So one-time supply law is very straightforward and simple. Earlier of the following three things will be considered tax point, and earlier of following three things means date of supply, date of issuance of tax invoice, date of receipt of money. So whenever the businesses are receiving any money, whenever they are making any supply, or whenever they are issuing a tax invoice, out of these three things, whichever will come first, it will be tax will be triggered, it will be considered tax point, it will be considered tax due date. So far as continuous supplies are concerned, where the invoices are being issued, issuance of invoices or payment in successive manners, tax point will be earlier of the following: date of issuance of tax invoice or date of payment. Out of these three things, whichever will come first, tax will become due. So in case this is a continuous supply, then tax will become due automatically by the end of 12 months from the date of supply. Specifically, they have given an example of operating lease contract, but I believe in case there any other supply which is a continuous supply, tax will become due automatically by the end of 12 months from the date of, from the point of sale, or you can say from the point of dispatch or delivery, whatever is the case. Vouchers, it depends. This is a single purpose voucher or multi-purpose voucher. A single purpose voucher, the date of supply will be date of issuance of vouchers, and for the multi-purpose voucher, date of supply will be date of redemption of vouchers. On the imports, date of import, VAT will be applicable on the date of import of goods, date of first point of entry, or date of release of goods, imported goods. So out of these three things, VAT will be applicable on the import as well. Place of supply, this is the most important concept in the VAT law. What will be the place of supply? Place of supply, to assess the place of supply, I have categorized the whole world into 5 zones. So first is the Oman. This covers Oman. In the Oman, there are two. This is the one is the mainland, and second is the free zones. Then third is the GCC country, the transaction in between Oman and GCC countries. This is the third phase. And fourth is Oman and rest of the world. And fifth is between the rest of the world. Your business is based in Oman, but the business is buying goods from China and selling it to Africa. The goods are not touching Oman land. So this is the fifth category. To understand the place of supply, we will discuss all these things one by one very carefully, because place of supply rules are very important to ascertain where the goods will be subject to tax, goods or services will be subject to tax. Will it be subject to tax in Oman? Will it be subject to tax out of Oman? It will not be subject to VAT. And based upon this, we will be assess the type of supply as well. So this is standard rated supply, zero rated supply, out of scope supply, or exempt supply. We will look into this. So first of all, place of supply of goods. This is a very general rule for the place of supply of goods. The first thing you need to keep in mind that place of supply of goods depends where the goods are actually located. It doesn't matter where the supplier is based, where the customer is based, where the goods are located. This is most important thing, and place of supply depends upon the location of the goods. So I am assuming goods are in the Oman mainland. If the goods are moving from the mainland to mainland, place of supply will be Oman, and it depends. These goods are zero rated, exempts, or out of the scope, or standard rated. Tax will be applied accordingly. And if the goods are moving from the mainland to the free zones, then still place of supply will be Oman, and law says this will be subject to tax as zero rated. And this zero rating subject to tax depends upon certain conditions which I mentioned here, that the customer which is based in free zone, customer should be a taxable person, customer should be licensed by the authority, customer is taking the supplies for the furtherance of the business. This is the key thing, that the goods are moving from the mainland to the free zone. Free zones, or they have already taken the permission from the Oman tax authority, because that every free zone is liable to take the permission from the Oman tax authority, which will highlight that anything supplied to the free zone will be zero rated. So this zero rating will be applicable subject to these conditions that I have just discussed. So if the goods are moving from the mainland to the GCC countries, then it depends basically GCC country is implementing state or not. And for the time being, we are assuming that the GCC country will an implementing state. If the GCC country is an implementing state, then place of supply will be destination country, and the destination country will apply a reverse charge mechanism. It means place of supply will be shifted from Oman to the respective GCC countries. But right now, there are no all the countries have not implemented VAT, so this is no concept of implementing state for the time being. Every GCC country will be treated like any rest of the world countries. So if the goods are moving from the mainland to any rest of the world countries, then it will be considered export, and export will be subject to tax at 0%, and businesses will be liable to keep some certain documents like commercial evidence, official evidence, which will reflect that the goods have been exported out of the Oman. So in case goods are already in the free zone, if the goods are in the free zone, it depends, goods are moving from the free zone to the free zone, it will be zero rated. If the goods are moving from the free zone to the mainland, it will be considered imports, and it will be subject to tax, and the importer will be liable to pay tax at the time of import of goods from the free zone. If the goods are moving from the free zone to the GCC countries, it will be zero rated. If goods are moving from the free zone to rest of the world, it will be zero rated as well. And the next is out of Oman. Goods are based out of Oman anywhere, might be in the GCC country, might be out of the GCC country. And if the goods are already in the GCC countries, and from the GCC country goods are moving in Oman, so it depends, goods are moving in the free zone of Oman or goods are moving in the mainland of Oman from the GCC country. If the goods are moving from the GCC country into the free zone, it will be considered VAT has been suspended, because goods have not entered in Oman on the mainland. So if the goods are moving from the GCC country on the Oman mainland, then importer will be liable to apply the reverse charge mechanism. It will be considered out of scope for the respective GCC country. Place of supply will be shifted from the GCC country to the Oman. Right now there are no implementing state concept in the all GCC countries, so it will be considered import, and importer will be liable to pay VAT at the time of import. And if the goods are moving out of the GCC country to the Oman, again it depends, goods are coming in the free zone or goods are coming on the mainland. For free zone, this will be considered suspended. Mainland's importer will be liable to pay VAT at the time of import. And if the goods are moving out of Oman to out of Oman, suppose goods are going from China to Africa, and the business is based in Oman, which is buying and selling, goods have not entered in Oman, so it will be considered out of the scope. The same thing I have mentioned here as well. If the goods are moving from outside Oman, GCC to rest of the world to free zone, VAT will be suspended, it will be out of the scope. If the goods are moving from the GCC countries to the mainland, importer will be liable to apply reverse charge mechanism. In case goods are moving from the rest of the world to the mainland, importer will pay 5% tax at the time of import. In case goods are moving from outside Oman to outside Oman, as mentioned, as China to Africa, it will be outside the scope of VAT. Place of supply of services. The very simple criteria to establish the place of supply of services, it depends basically supplier's residence. If the supplier has a residence in Oman, then place of supply will be considered Oman. And if the supplier has no place of residence in Oman, then it will be considered customer's place of residence will be considered place of supply of services. The same criteria I have tried to apply on the services as well. So it depends, supplier is based on the mainland Oman, supplier is based in the free zone of Oman. If the supplier is based in the mainland of Oman and giving customer is based on the mainland as well, so place of supply will be Oman. It all depends upon the type of services that is being provided. If the supplier is based in Oman mainland and customer is based in free zone, it will be considered zero rated, subject to condition that the customer is a taxable person licensed by the authority taking supplies for the furtherance of the business, so it will be considered zero rated. If the supplier is based in mainland and the customer is based in any GCC countries, then it depends, if this is the implementing state, then reverse charge mechanism is applicable, otherwise it will be considered export of services. If the customer is based out of Oman, supplier is based on the mainland, it will be considered export, it will be zero rated supply. You need to keep in mind that we are discussing these general rules, we are not discussing special rules. In case free zone, now supplier is based in Oman but in the free zone, so they are providing the services to the another free zone company, again it will be considered zero rated, subject to these conditions. And if the services are being provided from the free zone supplier to the mainland customer, these are the services, then place of supply will be Oman, and I believe 5% VAT will be applicable. If the free zone company, if the free zone supplier is providing services to any GCC countries, then it will be considered export, it will be zero rated. If the free zone supplier is exporting services to any party outside of Oman, outside of the GCC countries, again it will be export, it will be zero rated. Now supplier is based out of Oman. If the supplier is based out of Oman, it depends where the customer is based. If the customer is based in Oman, then it will be considered import of services and reverse charge mechanism will be applicable. And if the supplier is based out of Oman, customer is based out of Oman as well, so it will be considered out of the scope supply. It will not be subject to Oman VAT law. This is place of supply of special services. In the previous slide we have discussed place of supply of normal services or place of supply normal rules. Now these are the place of supply of special services. Transport and related services, place of supply will be where the transportation begins. Services related to the real estate will be where the real estate is actually located. Rental services of the means of transport is place of supply where the means of transport put at the customer's disposal. Wired, wireless, telecommunication and electronic services, place of supply will be where the actual place of use and benefits of these services. Place of supply will be considered the performance, place of performance for all these sections where the services are actually being performed. It will be considered place of supply. It doesn't matter where the it doesn't matter where the customer, where the supplier. We need to look into this where the services are actually being performed. It will be considered place of supply. And these are restaurants, hotel services, provision of foods and beverages, cultural, artistic, sports, educational, recreational services, goods transported and supplied to non-taxable person. Now we need to look into the value on which we need to apply tax. What will be the value on which we need to apply VAT? Now it depends the supplies in between unrelated parties, related parties, deemed supplies, imports or temporary exports. If this is the unrelated party, supply in between the unrelated party, what is the value which is being charged to the customer? It will be considered value and VAT will be applicable on that value. If the services are being if the supply is in between the related party, then market value in case where the value of supply is less than the market value. For the deemed supply, we need to apply VAT on the purchase price or cost. In cases we cannot ascertain the purchase price or cost, then we need to apply VAT on the market value. Imports are subject to VAT on the cost of goods, insurance, freight, excise, custom. We need to sum it up. After taking sum of all these things, then we need to apply 5% VAT. It will be the primary responsibility of the custom authority to calculate this value and apply 5% VAT. But we need to keep in mind that VAT will be applicable on the custom duty as well, VAT will be applicable on the excise duty as well, VAT will be applicable on the insurance and freight as well. In case of temporary export of goods, VAT will be applicable on the value which has been added in. So this will be considered taxable value for the implementation for the charging of VAT. Contractual terms are very important. We need to look into this. How the contract has been negotiated. If contract has been negotiated, VAT inclusive price quoted in the contract, suppose 100, so it will be assumed 100 includes VAT as well. So 100 is the VAT inclusive value. We will be liable to extract the VAT out of the 100, and this is the formula. This is a very common error people are making. They are taking 5% of 100 and they are asking VAT is the 5. No, this VAT is not 5. VAT is 4.76. It should be Omani Riyal. So 4.76 is the VAT value. In case supplier is negotiating VAT inclusive prices, it will have a great hit on their margin, because on every 100 they will be liable to pay 4.76 to the government. So their margin will come down, ultimately it will hit their profits. So we need to be very careful while negotiating with the customer. We need to negotiate price plus VAT. Price plus VAT 100 plus 5. Extra 100 will be collected from the customer and extra 100 will be paid to the government as well. This is simple. It should be Omani Riyal. Sorry for this. If the contract is silent and VAT clause is not given, then 100% treatment will be in case like scenario A, it will be considered VAT inclusive value. So these terms we need to teach it to the sales people whenever they are procurement team as well. Sales people, they need to do their best to negotiate the price plus contract. For sure, procurement team will try to negotiate the price inclusive of VAT. It all depends upon the negotiations. It all depends upon the contractual terms which has been agreed in between the parties. Deemed supply. Deemed supply means sometimes cases happen that the businesses are claiming input tax and they are not paying any output tax to the tax authority. They said if businesses are claiming input tax, then they are liable to pay output tax as well. So this is considered deemed supply. And the cases are if the businesses are giving gift and free samples for non-business activity. Suppose one business has taken mobile, they have claimed input tax, they have given to one of their friends. This is not for business purposes, not for business marketing, non-business activity. This will be considered deemed supply. We have already discussed they will be liable to pay VAT on the cost or the market value in case on the purchase price or the cost. In case they are not in a position to ascertain the purchase price or cost, they are liable to pay VAT on the market value for the deemed supplies. Supply of goods for no consideration. This activity is for business purposes, but it will be subject to some limitations. We'll look into the next slide. Business assets are being used for the private use, it will be considered deemed supply. Free management services, it will be considered deemed supply. Employees use the company car for personal use, it will be considered deemed supply. And the businesses will be liable to issue tax invoice, they will be liable to charge output tax on the deemed supply. But these are the exceptions. They said these will not be considered deemed supply and VAT will not be applicable in the following cases. Means goods are being supplied free of cost. Once these are being goods or services are being supplied free of cost, it will not be considered deemed supply. It will not be subject to VAT. What are they said the gifts or free samples provided to promote the sales of certain product. It will not be considered deemed supply. If the value of goods per recipient in the preceding 12 months period is 50 Omani Riyal excluding VAT, it will not be considered deemed supply. If the value of the goods at the company level in the preceding 12 months is 1000 Omani Riyal, it will not be subject to VAT, it will not be considered deemed supply. In case businesses have not taken the input tax, then still it will not be considered deemed supply. So basically these are the exceptions of deemed supply. And if these are the following four categories, then it will not be considered deemed supply and VAT will not be applicable. Otherwise, in case anything is being given free of cost on which input tax has been claimed, it will be considered deemed supply. Businesses will be liable to issue tax and they will be liable to charge VAT as well on the purchase price or cost or on the market value. Reverse charge mechanism. This is very important concepts. Reverse charge is basically recipient is required to account for the VAT instead of the non-resident supplier. If there is a non-resident supplier, they are supplying anything to the Oman, then the importers in Oman, they will be liable to pay output tax on behalf of the non-resident supplier. This is the reason this is called reverse charge mechanism. There is a big misconception in the market. People believe that reverse charge mechanism is output tax and input tax. It will have a nil impact on the business. No, this is not the case. These are two different legs. One is output tax, one is input tax. Output tax, yes, of course, business will be liable to pay output tax on behalf of the non-resident supplier. This leg is only called reverse charge mechanism. This leg, input tax, is not part of the reverse charge mechanism. So basically, wherever the business are liable to pay output tax on behalf of the non-resident supplier. This is called reverse charge mechanism. This eligibility to claim input tax, it depends upon the business. Basically, if the business is dealing with the taxable supply, it will be they will be able to take the input tax. They will be able to claim the input tax on the import of goods and services as well, where they are paying output tax on behalf of non-resident supplier. And if the business is dealing with the exempt supplies, then they will be liable to pay output tax, but their input tax will be blocked. So we can say reverse charge is basically one leg, paying output tax on behalf of non-resident supplier, and other stream of input tax, what the business is claiming. It all depends upon the normal criteria to claim the input tax. Multiple or composite supply. When two or more goods or any combination of goods are supplied in conjunction with each other, then this is called composite supply. And these are the conditions. If these conditions are being fulfilled, then this will be considered composite supply. These conditions are commercially as a single supply, components closely related to each other, all components essential to make the supply. Supply is made in the normal course of business. Combination of component does not aim to avoid tax. The best example I'm always giving is in case airline is providing the food services during the travel time, during the flight time. These food services, this is a composite supply along with the ticket. Airline is never ever selling, never ever charging ticket costs separately, food costs separately. In case they are charging on the invoice ticket cost and food costs separately, then they will be liable to pay tax as well on the individual components. But this is the composite supply, and they will charge price for the ticket only. So taxability, in case this is the composite supply, then VAT depends upon the principal component. Like in case of airline example, ticket cost or the food, a meal. Ticket cost is zero rated, meal is usually subject to tax. So overall taxability will be based upon the ticket, and ticket is zero rated. It will be considered zero rated supply. In case this is not composite supply, they will be considered multiple supply. And once this is a multiple supply, then tax will be applicable on each individual supply individually. Agent and principal relationship is very straightforward. If the agent is acting in the name of principal, then it will be considered supply by the principal. If the agent is acting in his own name, then it will be considered supply by the agent to the end user. This is a very straightforward thing. So we have discussed some important concepts, and we have looked into the, like we have gone through the value of supply, we have gone through tax point. In this section, we have gone through deemed supply, we have gone through composite supply, we have gone through reverse charge mechanism, we have gone to the what will be the value of the supply. I am sure it will be quite helpful to understand all these points. In case you have any question, you can drop us an email as well. Definitely it would be pleasure helping you. Our next section is taxability and transitional rules. To understand the taxability, we need to look into the type of supplies. And there are three types of supplies. One is out of scope supply, exempt supplies, and taxable supply. Out of scope, exempt, and taxable supplies. Taxable supplies can further be classified into zero rated supply and standard rated supply. Again, there is a lot of confusion. People believe zero rated supplies are not taxable supply. No, zero rated supplies are taxable supplies as well, but it will be subject to tax at 0%. What is the difference in between these supplies? For the out of scope supplies, business will be able to claim input tax, but no output tax. Exempt, no input tax, no output tax. Taxable supply, input output as well. This is the summary that I made for you, types of supplies. In case of out of scope supply, applicable rate, any rate is not applicable. Output tax not applicable. Business will be able to claim input tax. I just wanted to give you an example. Suppose one business in Oman, they are buying the goods from UK, and they are selling the goods to USA. So this is out of scope supply. But if this supply would have been made in Oman, it would have been subject to tax. then the business will be able to claim input tax. In this situation, business will be able to claim input tax as well. In case of exempt supply, applicable rate is nil. Output tax not applicable. Business will not be able to claim input tax. This input tax will become the cost of the businesses, and we have discussed in the very beginning that business will increase their price of the product because their operating costs will go up. They will increase the price of their product and they will shift the burden to the end user. Zero rated supply, applicable rate 0%, output tax not applicable, and input tax, yes, they will be able to claim 100% input tax. Standard rated supply, applicable rate 5%, output tax 5%, input, yes, business will be able to claim 100% input tax subject to certain conditions that we'll discuss in detail. One thing I wanted to highlight here, that we have discussed these 4 types of supplies across the globe, whichever the VAT law you can take, and in all those VAT laws they are mentioning these are the out of scope supply. List of out of scope supplies are usually given in the law. Usually exempt supply list is always given in the law. Zero rated supply list is given in the law. Then balancing standard rated supply, in the law they will never ever give you the list of standard rated supply. They will say this is outer scope, this is exempt, this is zero rated, other than this everything is standard rated. So we will look into this. What are the out of scope supply? These are the out of the scope supplies. Like statutory charges will not be subject to VAT because there is no supply against this. Salaries and wages will not be subject to VAT. Tips and gratuity will not be subject to. Intra-group transaction will not be subject to. Supply to GCC implementing state where the customer will apply a reverse charge mechanism. It will not be considered any taxable or exempt supply. It will be out of the scope. Transfer as a going concern, out of the scope. In third port import, like I mentioned, goods are moving from China to Africa. Goods are not touching Oman land. It will be out of the scope. Made by unregistered person, the unregistered person will not be able to charge any output tax. It will be considered out of the scope supply. Supplies between the free zones, it will be out of the scope. This is the list of the out of scope supplies. This is list of the exempt supplies. Then in case of exempt supply, no output tax, no input tax. Very simple rule. But cost will go up due to the exempt supply. These are the exempt supplies. Financial services, this is called margin based financial services. It will be exempt. Fee based services will be subject to tax. We will discuss in detail. Healthcare services and related goods and services exempt. Education services and related goods and services exempt. Bare land exempt. Resale or lease of residential properties exempt. Local passenger transport are exempt. Other than this, these following imports are exempt, and like imports and other things like imports where ultimate supply is exempt for a zero rated, it will be exempt. Imports of goods in favor of diplomatic or consular bodies certified by the Sultanate, it will be exempt. Import to the armed forces exempt. Personal effects, in case Omani study, then they are bringing anything out of Oman for the personal effects, use household appliances, it will be exempt. Supplies of non-profit charities, it will be exempt. Return goods exempt. Personal baggage and gifts exempt. So all these will be considered exempt supply, and we have discussed the criteria. If the business is dealing with the exempt supply, they will not charge any input tax. They will not be able to claim input tax as well. Input tax will become their cost. They will increase the prices of their products or services. This is a list of zero rated supplies. Food items, Omani government has given a list of food, 94, I think 94 and 99 food items. These are zero rated. They have given further extension of the items as well. There are 488 items. These will be zero rated. Supply of medicines and medical equipment, it will be zero rated. Supply of investment gold, silver and platinum with 99% purity, it will be zero rated. And after the extraction, first supply of the investment gold, silver or platinum will be zero rated as well. Supply of international GCC transport and related goods and services, it will be zero rated. Very beautiful thing, export of exempt services means Whatever the list of exempt services we have gone, if they are supplying locally in Oman, it will be exempt. If the same services are being supplied out of Oman, it will be zero rated. Then business will be able to claim input tax. They will not remain as an exempt supply. Supply of goods to outside GCC territory exports will be zero rated. Oil, gas derivative and natural gas will be zero rated. Supply of rescue plans, rescue assistance boats will be zero rated. Supplies of means and transport and related services will be zero rated as well. So we discussed list of exempt supplies, list of out of scope supplies, list of zero rated supply as well. Other than these three, everything will be subject to tax at standard rate, which is 5%. Now we are looking into the transitional rules. Transitional rules are very straightforward and simple. Whatever is being supplied after the effective date of the law, it will be subject to tax. It doesn't matter businesses, they have already issued the tax invoice or they have already received the payment, it doesn't matter. If the supply is being made after the effective date of the law, it will be subject to tax. This is straightforward and simple rule. I just wanted to give you an example. Suppose a payment is received in respect of supply of goods and services before the introduction of the law, which is 1st April 2021. Payment has been received before the introduction of the law, but goods were delivered after the introduction of the law, which is 20th April. They said payment received on 1st of April, car bought and payment date 1st of April, car delivery date, effective date of the law is 16th of April, car delivery date is April 21st. So if the car is being delivered after April 16th and onward, then it will be subject to tax. It doesn't matter invoice has been issued or payment has been received before this effective date of the law. So we have discussed in the previous section types of supplies, which supplies are zero rated, which supplies are exempt, which supplies are out of the scope, and what are the remaining supplies which are standard rated, and what are the related transitional rules. In case you have any support, you can contact us. Now we are focusing on the industry focus. We'll discuss some key industries very quickly. Impact on the industries. It depends. The industries are dealing with the zero rated or out of scope supplies, exempt supplies or standard rated supplies. If the industries are dealing with the zero rated and out of scope supplies, these industries will always be in a refund position because they will not be charging any output tax on their supplies, but they are eligible to claim input tax from the Oman Tax Authority. These all industries will be in a refund position. If the industry which are dealing in the exempt supplies, they will not have any output tax, their input tax will be blocked, their prices will go up. And the industries which are dealing with the standard rated supply, they will always be in a payment position to the Oman Tax Authority because their output tax will always be higher than their input tax. So real estate sector. Bare land we have already discussed, it will be exempt. Development of sites and contracting services will be subject to tax 5%. Resale of residential properties exempt. Rental of properties for residential purposes more than 3 months it will be exempt. Less than 3 months it will be considered standard supply, it will be subject to tax. All commercial properties will be subject to tax. Their sale, their lease, it will be subject to tax at 5%. You need to keep in mind all these criteria will be applicable. We need to keep in the place of supply rules as well. We have already discussed place of supply of the real estate sector, where the real estate is actually located. If the real estate is located within the free zone, then supply will be considered zero rated supply. We need to look into this as well. Real estate related services have the same taxability like the real estate. These are the real estate related services like engineering studies, management, construction services, residential services, granting any rights over the property services, contractual rights services, building demolition services, types of building, management, maintenance, real estate agent, brokers. All these services have the same place of supply like the real estate place of where the real estate is actually located, and they have the same taxability like the taxability of the real estate. Financial sector, we have already discussed. Fee-based financial services will be subject to tax at 5%. Margin-based financial services will be exempt. And the biggest example of banks, insurance company, there will be a residual input tax. Residual input tax means which input tax which belongs to taxable as well as exempt supplies, and businesses will be liable to residual input tax, liable to apportion the residual input tax to claim the input tax related to the taxable supplies only. Healthcare sector, this is the complete list of exempt services of healthcare sector. These are the standard rated services related to the healthcare sector. Education sector, they said educational services and related goods and services, if these are being provided by the institution licensed by the competent authorities and they are teaching approved school curriculum, then it will be considered exempt, otherwise it will be subject to tax. So these are the all educational services. You can go into the list. All these services are exempt services, and these are the related goods and services that directly related to the educational services and limited to the students. These will be exempt as well. If any educational services or any related goods and services which are not part of these educational services, or these goods and services are being provided by the financial institution which is not licensed by the respective competent authorities and they are not teaching any approved school curriculum, then it will be subject to tax at standard rated, then it will not be considered an exempt supply. VAT on metals. The supply of investment gold, silver and platinum, if this is the 99% purity and these are being traded in the global bullion market, it will be zero rated. First extraction will be subject to tax at 0% on the first supply after extraction of investment gold, silver and platinum. Second supply, if 99% purity, zero rated, otherwise it will be subject to tax. Oil and gas sector, they said supplies of crude oil, oil derivatives, natural gas and related goods and services will be zero rated as well, subject to the condition that primary activities, these supplies are related to the primary activities and intermediate activities. Supplier and customer both are registered and licensed by the Ministry of Energy and Minerals. Supplier and customer both are the taxable or VAT registered parties. Customer has received supplies for the purpose of carrying out primary activities and intermediate activities. If these conditions are being fulfilled, then supply of crude oil, derivatives, natural gas and related goods and services will be zero, otherwise it will be subject to tax. Next is the compliance section. This is very important area of the presentation. And I have classified the compliance requirements into the 5 sections. First one is the VAT registration, second output tax on sales, input tax on purchases and expenses, return, payment, refund, retention of record. Businesses, they need to assess their taxable value of supplies. If they are they are falling under the 4 categories that were discussed earlier, they need to get themselves registered. This is the first thing. In case they are not getting themselves registered, we will look into the penalties as well. Output tax on sales, they need to assess a proper tax position. After assessing the proper tax position, they need to charge output tax properly and they need to report output tax properly in the system and ultimately in the return. Input tax on purchases and expenses, they need to have a proper tax invoices from the supplier. They need to assess their claimability and claim either the business can claim input tax or not, and then they need to book it as an asset or expense. It depends. If the business can claim input tax, they need to book it as an asset. Otherwise, they can book it as an expense or they can capitalize this item as well. In case they are buying anything, suppose they are buying any car and the car they cannot claim input tax. They need to look into the IFRS requirement. They need to assess, they need to capitalize it, and they need to expense it out. Then at the end, they need to net out input tax and output tax. They need to submit the return. They need to make payment or claim refund based upon the bottom line. If output tax is higher, they will be liable to pay input. If input tax is higher, they have a right to claim input tax. Retention of record, they need to maintain the record, keep it manually or electronically for 10 years for every business, but for the real estate sector, the retention of the record requirement is for 15 years. Now we'll discuss all these sections one by one. Input tax recovery, I have prepared this chart for you. The first question that you need to ask from yourself, input tax related to the business? No. If input tax is not relating to the business, you cannot claim input tax. If this pertains to the business, next question, is this a blocked input tax? Yes. If input tax pertains to the business, but this is a blocked input tax, you cannot claim input tax. Now input tax related to the business, this is not blocked input tax, means the business has taxable, then you need to have business is taxable supplies or exempt supply. If the business have exempt supplies, and business supplies exempt supply in Oman or out of Oman. We have gone through the list of exempt supply. If these services are being provided out of Oman, then business can claim input tax. Otherwise, business cannot claim input tax. The fourth question is business has 100% taxable supplies. So basically, the first question is input tax is for the business. Second, this is not blocked input tax. Third, this doesn't pertain to taxable supply. Fourth, this 100% related to the taxable or out of scope supplies. Then business can claim 100% input tax. But it's some portion pertains to taxable supplies, some portion pertains to exempt supplies. Like I have given an example for the financial sector. They are residual input tax, and this residual input tax will be a portion in between taxable and exempt supply, and the portion pertaining to the taxable supply, businesses will be able to claim input tax. And to claim the input tax, only registered person can claim input tax. Unregistered person cannot claim input tax because they will not be liable to submit the return. They will not be able to claim it as well. Recoverable if valid tax invoice is in hand. Recoverable up to 3 years from the date of end of the tax period. Allowed on goods approved to be lost, stolen or damaged. Approved on commercial samples up to certain value. Blocked on goods prohibited to be imported, supplied or exported. It cannot be claimed. Pre-registration input tax allowed. Blocked on the following categories, because this is the blocked input tax and businesses cannot claim this input tax. Even the business are making taxable supplies. Even the business are making 100% taxable supplies. Like entertainment, they cannot claim. Employee personal benefit, they cannot claim. Motor vehicle and related goods and services, where the motor vehicle is available for personal use, they cannot claim. And they have defined the motor vehicle where the motor vehicle can carry less than 10 passengers, including drivers. Provision of food and beverage catering services, they cannot claim input tax. So this is the criteria to claim the input tax. If you are fulfilling this criteria, you need to claim the input tax. Otherwise, you should not claim input tax. And to claim the input tax, you must have proper tax invoices in your hand. You can claim it maximum within 3 years from the end of tax period. Now the concept of reimbursement and disbursement, you will not find these words exactly into the law, but this all depends upon the interpretation and industry practices. Reimbursement and disbursement. We have already discussed in the previous slide, if the business expenses are not for the business, they will not be able to claim input tax. But if this is the expense for any other businesses, but the business is getting tax invoice in its name, this is called reimbursement. And these are expenses for any other businesses, and the business is making only payment. Invoices are not getting in business in its name. This is called disbursement. So here invoice will be in the name of the business in the reimbursement, and business will be making the payment. In case of disbursement, invoice will be in the name of any other business and business will be making the payment. So in case of reimbursement, it all depends upon the line item taxability. If the line item is subject to tax, the business needs to claim input tax and charge output tax. If the line item is not subject to tax, business should not claim input tax and they should not charge any output tax. In case of disbursement, where the business is making the payment and business is not receiving the tax invoices in its name, this is called disbursement. Business will make the payment and route it through the balance sheet as a receivable and payable. It will not have any impact on the profit and loss account. It will not have any impact on the input tax as well as output tax. Retention of the record and return. As we discussed, Maintain record like invoices, credit notes, debit notes, export documents, import document. Records must be kept on paper or electronically for 10 years and for real estate for 15 years. Return and payment. If net VAT payment where the output tax is greater than input tax, it will be payment. Tax period not less than 1 month. It will be always be more than 1 month. Return required to be submitted within 30 days from the end of the tax period. Payment required to be processed in 30 days from the end of tax period. Taxable person may allow to revise return in 3 years. Refund. Where input tax is greater than output tax, it will be refund. Tax paid by specific diplomat, consular bodies, international organization, and the condition of priority, they can claim input tax as well. Non-resident businesses, they will be able to claim input tax as well, subject to certain conditions. Tourists, they will be able to claim input tax as well, subject to certain conditions. Key role of the AP team. AP team, as we discussed earlier, they must have a comprehensive tax invoice in hand, then they can claim input tax. If the value of the supply is more than 500, they need to have a comprehensive tax invoice. They need to fulfill all this checklist while receiving the tax invoice. If this checklist is being honored, then they need to accept the invoice. Otherwise, they need to reject the invoice. They should not accept the invoice. They should not release the payment unless and until they are getting proper tax invoices from the supplier. Invoice should be in Arabic or in English and Arabic. This is the requirement of the law. At the time of receipt of invoice, they need to put the date of receipt of the invoices as well, and claim allowable input tax if you have the proper tax invoices in hand. Do not claim input tax if you do not have a proper tax invoices in hand. Fractions up to 3 decimals for the invoices. This is a simplified tax invoice contents in case the value is less than 500. This is a simplified tax invoice. Again, it should be in Arabic and English or Arabic. It should be a proper tax invoice. Then they need to accept the invoice, release the payment. Otherwise, they should not accept the invoice. They should not release the payment. Make sure that you are not entering any garbage in the system. If this is not a VAT compliant invoice you are entering into the system, it will be very difficult for you to pull out the non-compliant invoices. Better you need to have a checklist in front of you before entering into the system. You need to fulfill and honor this checklist. Then you need to accept the invoices. Some other key requirements as well. The taxable person shall present the prices inclusive of VAT for goods and services. They can postpone the deduction of input tax for a period of 3 years. Payment on the import of goods can be suspended as well with the approval of the authority. 2 or more entities can go into the VAT group subject to certain conditions. Then in case they are going into the VAT group, then intergroup transaction will not be subject to VAT. If the business are only dealing in 100% zero rate supply, they can apply for exception from the registration as well. In case they are applying for exemption from the registration, their input tax will be blocked. Hopefully they will not go for it. Any changes in data required to be updated to Oman Tax Authority within 30 days. Invoices on behalf of taxable person. Taxable person may empower any other person to issue tax invoices on their behalf, but they need to sign an agreement. And approval of the authority is required as well. Tax invoices required to be issued in Omani riyal. In case any other currency is being used, then they need to apply the exchange rate, average exchange rate of the date of supply, and average exchange rate can be calculated buying rate, selling rate of the date divided by 2. This will be average exchange rate. Taxable person cannot maintain any accounting record of books in foreign currency except after receiving the written approval from the authority. A taxable person may request to defer the payment of tax due upon import until submission of the tax return. They need to take an approval from the authority as well. If the responsible person wishes to remain outside the Sultanate for more than 90 days, they need to take an approval from the authority. They need to apply at least 50 days before the date of the departure, otherwise it will be subject to penalty. Any document which is being submitted to the authority shall be considered signed by the responsible person and received by the authority on the date of the receipt. For import and export of a country, they need to maintain the minimum commercial documents like bill of entry, export bill of entry, exit certificate, and transporter or shipper bill. Tax will become due. This is very important in case goods are being supplied. Tax will become due on the date goods are accepted by the person, or the date not exceeding 1 month after the date of transport to him, or putting under his disposal, whichever is earlier out of these three things. Means if the goods are being supplied, maximum approval time is 30 days. After 30 days, it will be considered supplied and it will be subject to tax. In case discount is being offered, there should be a proper clear policy for the discount, then VAT will be applicable on the discounted price. Otherwise, you cannot apply VAT on the discounted price. In case of vending machines, date of supply will be when the cash will be received from through the vending machines. In case the value of supply is going up or down after making the supply, then the business, if the value of supply is going down, they can adjust it to the tax credit note. If the value of the supply is going up after supply, the business needs to issue tax debit note. Value of the supply can be reduced if the taxable person has published for consistent and commercial policy for discount. As I mentioned earlier as well, you should have a discount policy, otherwise you cannot apply VAT on the discounted price. Taxable person may adjust the value of supply tax if the consideration was not fully or partially collected, subject to some conditions. Pre-registration input tax can be claimed as well by submitting a separate application to OTA in 30 days, which required audited numbers as well if the value of the goods exceeds 50,000 Omani Riyal. Goods related to goods bought before the VAT registration input tax can be claimed if the goods has been bought in preceding 3 years and these goods are available for supply for you, then you can claim input tax. In case of services, you have taken the services within the preceding 6 months before registration, then you can claim input tax. Otherwise, you cannot claim pre-registration input tax. The concept of direct export and indirect export goods required to be exported within 90 days in case of indirect export. If output tax is required to be paid under the reverse charge mechanism, then a person must record on the tax invoice issued in its favor from the supplier the value of tax due in Omani Riyal and indicate the supply is under the reverse charge mechanism. These conditions are required to be fulfilled as well. Tax invoicing function can be outsourced as well after the approval of the authority. Taxable person must issue an amendment document in case amended invoice where the value of the supply is being changed after issuance. Records required to be kept preferably in Arabic language. In case it is being kept in any other language, then approval of the authority is required. Moreover, you can keep the record in any language, but whenever the authority is asking for the record, you need to produce the record in Arabic language. Impacts of non-compliance. These are key risks related to the VAT. Fails to identify impact on VAT. Underpaid VAT means you are not adopting a proper tax position. This is the biggest risk. You will be liable to subject to huge penalties. You are paying less tax to the OTA. You are taking wrong tax point, wrong tax position. It will be again subject to penalties. Your reputation will be damaged. Impair businesses, the relationship as well, because all the supply chain players are interconnected. So these are the biggest risk related to the VAT. And in case tax audit is being opened by the Oman Tax Authority, they will apply a risk-based selection criteria to determine whom to audit. OTA will conduct the audit at the person's place, or they can conduct the audit remotely as well. OTA has the right to enter any place where the taxable person carries out the activity. OTA employees have the right to enter any automated electronic system. OTA may review the records, books, documents, and carrying out meet or discuss the employee, and they can conduct the interview of the employee as well to get the more and more information. OTA will notify about the audit 15 days prior to the date of audit. Businesses will be required to provide the record within 3 days from the date of their request. You need to be mentally prepared, and you need to prepare and make the arrangement. The data is available within 3 business days whenever the OTA is asking. The tax period for inspection shall be 3 months, which can be extended as well. In case there is a non-compliance, there is a key penalties related to the non-compliance, like deliberately refraining to issue a tax invoice maintain record, submit tax return, identify responsible person. You are deliberately doing this non-compliance, then penalty will be imprisonment 2 months to 1 year. Fine 1,000 to 10,000 Omani Riyal. Deliberately refraining to register, submitting unforged return, destroying record, not submitting actual data in the return, then imprisonment 1 to 3 years, fine 5,000 to 20,000. Failure to display tax registration certificate. This is requirement of the law. You need to display the tax registration certificate in Oman on every fixed establishment. If you are not displaying, then penalty will be 500 to 50,000. Failure to file tax return report, penalty will be 500 to 50,000. In case you are involved in the tax evasion, then penalty will be 300% of the difference in tax due related to this tax evasion. Failure to maintain record, penalty will be 500 to 50,000. Failure to display VAT inclusive prices, penalty will be 1,000 to 10,000. Failure to declare the actual tax in the return, penalty will be 1% to 25% of the differential amount, total amount to be declared and actually declared. This is a huge amount of penalty. You need to be careful. Way forward. What you need to do, basically, you need to go for a proper impact assessment. In the impact assessment, you need to, what will be the potential effects on the margin. You need to assess pricing, cash tax impact, cash flow impact, VAT issues under the deals. What will be the tax position on the sales? You can claim input tax, you cannot claim input tax. What will be the overall impact on the HR department, procurement department, sales department? How to train the sales people, how to create the code. These will be the all overall impact on the organization. You need to look into, reflect the VAT law, identify correct VAT treatment of the every business transaction, industry specific zone, intra GCC country, free zones, procurement team, VAT treatment of purchases and imports, procurement, contracts and margin, technology and system. It will have impact on the technology and system as well. System required to be changed, VAT compliant, reporting, creating code, account payable, receivable, IT architecture impact, process and compliance impact, data analytics to enhance compliance. Sales and marketing, then VAT treatment of sales, effective demand, pricing, customer arrangement impact. This is continuous compliance as well. So this will be the basically way forward. You need to go for it, have a proper impact assessment, teach your team, train your team, make the system changes in the system, go for automation, and go for continuous compliance, continuous review as well. You need to make sure that business is a VAT compliance to avoid all these hefty penalties. I have this team-wise responsibility created for you as well. Management, first of all, they need to set up the governance framework. They need to assign the roles and responsibility of the people. Then business development team having knowledge of the VAT, because this is very critical whenever they are negotiating the contracts with the respective parties. This play a very key role. Invoicing team, they need to adopt a proper tax position on sales, charge output tax properly, issue VAT compliance tax invoice. In case this is being done by the system, they need to review the system very frequently that everything is in order. Procurement team having knowledge of VAT and the purchases, they would be in a better position to negotiate with the supplier price inclusive of VAT. It will be quite beneficial. Account payable team, they have very good knowledge. This is the most critical area because these are the people who are entering invoices into the system. They need to have a knowledge which input tax is allowed, which input tax is not allowed. This is a VAT compliant, the VAT non-compliant invoice. They need to look into this all factor. Reporting team, they need to prepare a report, adjust input and output tax. They need to submit a proper report to tax authorities as per the guidance, as per the format provided to them. IT team, they need to create code, invoice template, automate data analyst, compliance automation, continuous review. The system is a VAT compliant as well. So this is a team-wise responsibilities. How can we help? We can help in the impact assessment. We will assess what will be the impact of VAT on your whole business. We will see what is the tax position, which input tax is blocked, which input tax is not blocked. We'll go through your transaction. We'll do the transaction mapping. At the transaction map, at each transaction level, we'll be able to assess their taxability. We'll assess the place of supply. We'll assess the type of supply. We'll assess the rate of VAT as well. Then we'll be in a better position to assess and advise you what will be the impact of VAT on your whole business. In case your business is subject to VAT, then we'll advise you apply for the VAT registration. We'll go for implementation. We'll sit with the IT team, we'll make the changes in the system, changes in the contract, and we'll make sure that VAT has been implemented very properly in your organization. You can provide training to your staff as well to make sure they are implementing or they are moving ahead, they are following our guidance, and they are making everything VAT compliant. Review and submission of the return. We are helping business in the review and submission of return as well. We are providing continuous support and compliance whenever the changes are coming into the law. We are advising our clients, we are keeping them updated, we are providing them day-to-day advice, we are submitting the return, and we are making sure that our clients are VAT compliant and their staffs are quite updated with the latest developments in the law. Crest Cooper's profile. Crest Cooper was set up with the vision to become a global resource of business's choice for professional services. Our ambition is to provide simplified and bespoke business solution globally in a timely and cost-effective manner. We are committed to become strategic partners in all stakeholders' growth by nurturing and implementing innovative ideas. These are the key clients that we are serving in the region, like Mazda, Atlantic Maritime, Talibat, Khalij Time, Ketenge, Komatsu, Khidma, Arjo, Baskin Robbins, JCB, Gala, Sinopec, TriStar. These are the key clients that I've taken from a portfolio. We are already serving in the GCC region. We have already implemented VAT, and we have recently done the impact assessment. A lot of businesses in Oman as well, we are supporting them to be VAT compliant. Our footprints are, we have offices in USA, we have head office in UK, UAE offices there as well, we have offices in New Zealand. So in case you are in need of any support, we are available. You can contact us on info@crestcooper.com. You can give us a call as well. So it will be pleasure supporting you. Thank you very much for your time.
Thanks for watching the video. Click on the bell and subscribe to the YouTube channel.